36 hours. That's how long it took for $7 trillion to vanish from global financial markets. Not over weeks, not over months. In less than 2 trading sessions, wealth equivalent to Germany's entire economy disappeared. This wasn't a correction. This was systematic liquidation across every asset class simultaneously. Stocks, bonds, commodities, currencies, crypto, everything sold at once. The last time we witnessed this magnitude was September 2008. Before that, October 1929. But this crash is different, bigger, faster, and it reveals fractures that make 2008 look like practice. Something fundamental just broke. Most people have no idea what they witnessed. Let me show you exactly what happened. The mathematics of systematic collapse, and why we've crossed a threshold with no return. Because this wasn't just a crash. It was a stress test of the modern financial system, and the system failed. Monday, 8:45 a.m. European bond markets explode. German 10-year yields spike 47 basis points in 12 minutes. That's a 5-year move compressed into 12 minutes. French bonds follow, Italian, Spanish. The entire European sovereign debt market sells off simultaneously. But here's the difference. No economic news triggered this, no announcement, no policy change. This is forced liquidation. Somewhere in the system, massive leveraged positions are being liquidated to meet margin calls. Not choosing to sell, forced to sell. 9:15 a.m. Contagion jumps the Atlantic. U.S. Treasury futures open limit down. The 30-year Treasury, supposedly the safest asset in the world, drops 3.2% pre-market. When the safest asset gets liquidated aggressively, the crisis isn't about risk. It's about liquidity. Institutions need cash immediately. 9:30 a.m. U.S. markets open, S&P 500 gaps down 4.1%. But that's just the beginning. Within 1 hour, volume exceeds the previous day's entire session. Every sector bleeds. Technology down 7%, financials down 8%, energy down 6%. This isn't rotation. This is systematic indiscriminate selling across every financial asset category. The VIX spikes from 18 to 47 in 2 hours, 161% increase. Options flow shows massive put buying. Someone is betting enormous money this crash accelerates. By noon, the damage assessment begins. U.S. equities lost 2.1 trillion in 2.5 hours. European markets lost 1.8 trillion euros. Asian markets another 1.2 trillion. We're at 5 trillion in wealth destruction. We're only halfway through day 1, 2 p.m. Eastern. Something happens, not seen since September 2008. Credit markets freeze, corporate bond trading halts, bid-ask spreads widen to Lehman collapse levels. Investment-grade bonds, trading at 3.5% yields, are now quoted at 5.2%. That's not normal volatility. That's repricing corporate credit risk because investors believe we're entering immediate recession. But the corporate freeze triggers worse. High-yield bonds go into complete liquidation. Yields spike from 7.8 to 12.3% in 3 hours. When junk yields cross 12%, historically that signals corporate bankruptcy waves. Companies can't refinance. Cash flows, manageable at 8%, become impossible at 12%. By market close, S&P 500 down 8.7%. Day 1 damage, 4.2 trillion destroyed. Tuesday opens catastrophically. Asian markets gap down 6 to 9%. Tokyo halts trading. Shanghai falls to 2019 levels. But Tuesday brings something new. Currency market breakdown. Japanese yen strengthens 4.7% against the dollar in 6 hours. This devastates global markets. Here's why. For 15 years, investors borrowed yen at 0 rates and invested in higher yielding assets worldwide. The yen carry trade involves $4 to $6 trillion globally. When yen strengthens rapidly, carry trade investors must buy yen to repay loans. To buy yen, they sell everything. Stocks, bonds, commodities. Everything liquidated. The yen spike triggers global leveraged position unwinding that dwarfs Monday. European markets open down 7 to 9%. Unlike Monday's sector-specific selling, Tuesday is completely indiscriminate. Everything liquidated at any price. FTSE drops 9.2%, DAX falls 8.8%, CAC declines 9.1%. Moves not seen since March 2020, compressed into one morning. U.S. markets open down 6.1%. But Tuesday brings algorithmic amplification. High-frequency systems detect momentum and accelerate the sell-off. Selling triggers more selling. 247 individual stocks halt trading. NYSE implements market-wide circuit breakers for the first time since March 2020. Here's the terrifying part. Central bank intervention isn't working. Federal Reserve announces emergency facilities. ECB pledges unlimited purchases. Bank of Japan intervenes. None of it stops selling. For the first time since 2008, markets decline despite aggressive central bank intervention. The crisis has moved beyond monetary policy. By Tuesday's close, additional 2.8 trillion destroyed, total 7 trillion. But 7 trillion doesn't capture what happened. This was systematic breakdown, revealing fundamental instabilities. 4 mechanisms turned routine correction into systematic collapse. First, leverage. The system is more leveraged than 2007. When markets decline, everyone faces margin calls simultaneously. Everyone forced to sell. Second, algorithms. 70% of trading is computer generated. When markets decline systematically, algorithms amplify the movement beyond fundamentals. Third, correlation. In crises, everything moves together. Diversification provides no protection because everything liquidated simultaneously. Fourth, carry trade unwind. $5 trillion borrowed in low-rate currencies invested globally. Currency strength forces liquidation regardless of fundamental value. These 4 factors create phase transition. The system doesn't adjust gradually. It snaps from stability to systematic liquidation instantly. That's what you witnessed. The global financial system snapped. This crash is worse than 2008. In 2008, the problem was specific. Subprime mortgages. Identifiable, containable, addressable. This crisis has no origin point. It's about system structure itself. The system depends on continuous growth, liquidity, and confidence. When any wavers, everything becomes unstable. 7 trillion didn't disappear because fundamentals deteriorated. Corporate earnings haven't collapsed. Unemployment hasn't spiked. 7 trillion disappeared because the system discovered it couldn't maintain its leveraged algorithmic structure without continuous central bank support. This is worse than 2008 because the problem isn't assets. The problem is the system. Global debt to GDP, 356%, higher than any point in history. Corporate debt, 95% of GDP. 2007 was 67%. Government debt, 128% globally. 2007 was 78%. Household debt, 113% of income. 2007 was 103%. More leveraged at every level than ever. The crash demonstrated what happens when leveraged systems face synchronized liquidation. The derivatives market, $600 trillion notional value, 8 times global GDP. During the crash, these markets experienced massive disruption. When derivatives malfunction, it affects the entire system because every major institution uses them. The Federal Reserve spent $2.3 trillion stabilizing 2008. Based on current leverage, the next crisis requires 10 to 15 trillion intervention. But the Fed's balance sheet is already 7.4 trillion. Government debt is unsustainable. Traditional crisis tools are exhausted. Central banks won't have capacity to stabilize like 2008. The adjustment comes through market forces. Asset prices fall until leverage becomes sustainable. 7 trillion destruction was just the beginning. Wednesday brought unprecedented development. Markets ignored central bank intervention and resumed selling. Central bank intervention has been the reliable circuit breaker since 2008. When central banks announce support, markets always rally. Wednesday, markets declined despite active intervention. We've entered new dynamics where traditional tools are ineffective. For 15 years, investors assumed central banks would backstop any decline. That assumption just proved incorrect. Markets can decline despite central bank support. That changes everything about risk assessment and systemic stability. This repricing has begun. 7 trillion was the market's initial attempt to price in a world where central bank intervention is not guaranteed effective. But 7 trillion is probably just the beginning. If markets can't rely on central bank backstops, risk premiums across every asset class must increase dramatically. The 36-hour crash wasn't isolated. It was the beginning of systematic repricing across the global financial system. The system discovered its primary shock absorber. Central bank intervention is no longer reliable. Their power has limits markets are now testing. Those limits are mathematical. Central banks can create unlimited money, but not unlimited economic value. They can buy unlimited bonds, but can't make them risk-free if governments become insolvent. Markets are focusing on mathematical limitations, rather than assuming central bank omnipotence. This represents a fundamental shift in market psychology that cannot be reversed through policy. Once markets test central bank limits, testing continues until limits are established. That involves stress testing every assumption supporting markets since 2008. Government debt is risk-free. Major banks cannot fail. Real estate only increases. Stock markets always recover. Each assumption will be tested. Some will prove incorrect. 7 trillion was the market's opening bid in systematic stress testing of post-2008 assumptions. Testing has just begun. It won't end until mathematical reality is fully priced into markets. More crashes, more volatility, more destruction. Not isolated events, but continuous adjustment toward equilibrium reflecting fundamentals rather than intervention. The 36-hour crash wasn't the crisis. It was the warning the crisis is beginning. Unlike 2008, this cannot be solved by printing money. This crisis is about the mathematics of money printing itself. The system discovered its limits. Now it must operate within them. $7 trillion disappeared because the system began pricing in a world where mathematical reality takes precedence over monetary policy. This is bigger than 2008 because it's not about specific failures. It's about the system reaching mathematical limits that cannot be overcome. The crash was the market saying, old rules no longer apply, new rules being written through systematic stress testing. The first draft cost $7 trillion. This is not the end. This is the beginning. Mathematics have changed. The system is adapting. That adaptation will devastate anyone who doesn't understand we just entered completely different market dynamics. But here's what mainstream media won't tell you. This wasn't random volatility. This was controlled demolition of over-leveraged positions built for years. The yen carry trade involved $5 trillion borrowed money. When positions unwound over 36 hours, selling pressure overwhelmed every stabilization mechanism. Think about mathematics. 5 trillion leveraged positions forced to liquidate simultaneously. That's more than Japan's GDP, more than Germany's entire stock market. All sold in 36 hours. No market structure can absorb that selling level. No central bank intervention can counteract mathematical reality. This reveals fundamental post-2008 flaw. Central banks created liquidity that investors borrowed unprecedented amounts chasing returns. That worked until something forced simultaneous selling. When synchronized selling began, leverage amplified every decline. Normal profit-taking became forced liquidation. Forced liquidation became systematic collapse. Systematic collapse revealed the emperor has no clothes. The system depends on confidence someone else will buy. When confidence breaks, there's no floor. The $7 trillion wasn't lost to better opportunities. It wasn't transferred to different markets. It vanished because it was never real wealth. It was leveraged speculation masquerading as investment. When leverage unwinds, speculation disappears. Mathematical reality remains. Mathematical reality is brutal. The 36-hour crash was mathematical reality asserting itself over financial engineering. The system discovered it couldn't maintain artificial valuations. That discovery has begun. $7 trillion was down payment on adjustment required before system stabilizes. The 36-hour crash was your warning. Mathematics have changed permanently. The system is adapting to new reality where old rules no longer exist. It's a systematic restructuring of global finance. The $7 trillion destruction was the opening chapter of a much larger story. The old world operated on the assumption that central banks could backstop any crisis. That world just ended. The new world operates on mathematical reality, and mathematical reality is unforgiving. When leverage exceeds sustainable levels, it must be reduced. When speculation exceeds productive value, it must be eliminated. This is not opinion. This is mathematics. Cold, brutal, undeniable mathematics. The system discovered its mathematical limits over 36 hours. $7 trillion was the cost of that discovery. But the learning process has just begun. The derivatives market alone is $600 trillion. The global debt to GDP ratio is 356%. The leverage in the system exceeds anything seen in human history. When this leverage unwinds, $7 trillion will look like a rounding error. The 36-hour crash was not the main event. It was the preview. Mathematics always wins. Always. The only question is timing. And the timing just accelerated dramatically. The system tried to postpone mathematical reality for 15 years. That postponement just ended. The 36-hour crash was your final warning. The mathematics have spoken. The system is adapting, and that adaptation will destroy everything built on false assumptions about central bank omnipotence. Welcome to new reality, where mathematics governs markets, where leverage kills, where speculation dies, real values.